Ladies and gentlemen, thank you for having me. Let me first start by saying that I am humbled to be standing in front of you here today. To quote Ravi, no human endeavor is more important. No human endeavor is more important. I'm humbled to be standing here in front of you. I'm also really delighted. I'm delighted, I am passionate about this topic. I'm delighted that there are so many of us in this room that are here to be part of the solution. You might have heard a few months ago, Ravi mentioned some of the numbers. McKinsey Global Institute put out a report detailing the $9 trillion per year that is required to achieve a just transition to net zero. $9 trillion. What we would like to do today is basically to zoom in on APAC, and we would like to zoom in on how blended finance can play a critical role, actually a more than $900 billion role in that transition. But let's first ground ourselves in some numbers. On the chart here behind me, you see on the left, 9.2 trillion, that's the number that is needed for this just transition to net zero. At the bottom there, 6.5. That is the amount of money that is required over and above what we're spending on high emission assets today. So $6.5 trillion is required into low carbon emissions assets. In the middle, what you see is the APAC share, 3.1 trillion of that 9. At the bottom, $2.4 trillion per year is required across the APAC region. That is an increase into low carbon emitting assets. And then you see the split on the right-hand side. You see ASEAN 8, which is basically ASEAN minus Singapore minus Brunei, $400 billion per year. You see advanced Asia, which is Japan, South Korea, Singapore, Australia, and New Zealand. You see India and you see China at $1.1 trillion. And I know we have a number of colleagues from Africa and Middle East here. $600 billion per year is what is required for that just transition. Now, these numbers, these are regional averages. Just go back a second, please. These are regional averages. You will see that in China, this is going to go up and then down, whereas in ASEAN and India, there's going to be a steep curve all the way up until 2050. So it's a little bit different profile in different regions. But we can all agree that these are formidable challenges ahead. Much, and this is the issue that Ravi also alluded to. I'm not going to go repeat, but many of these investments are not bankable today. You see in the top left corner there, the projects, the returns and the risk profiles are such that they don't compete with the traditional, the investments into traditional fuels, for example, especially when we lack a true carbon price. I think Ravi covered this well. I'm going to skip to the next page, please. So how does blended finance help? So first of all, what we're talking about here is using blended finance, i.e. using public money to catalyze private money. Public money to catalyze private money. 5 different types of instruments you see on the top there: grants, equity debt, guarantees and insurance, and technical assistance. Now, these are used to improve returns, they're used to lower risk, they are used to create markets. We can see blended finance used at different levels. We see it used at the project level. We see it used at the fund level. We see it used at the institutional level. And I'm going to come back with a number of examples a little bit later on. What we've tried to do on the right-hand side of this chart is basically visualize what we're trying to do on a risk-return graph here. We're trying to move from the non-bankable zone on the south side of that diagonal and move the projects into the bankable zone. That is the purpose of trying to crowd in more private finance through blended, through public financing. We have modeled more than 60 different asset classes. We have modeled that to see first how much money is actually required. Then we've looked at the evolution of risk return of these different asset classes. We know that technology costs and so forth are going to come down. So we looked at how much money is going to be needed over the next decade. This is up until 2030. This chart shows the different asset classes, where they are on average across the APAC region. The size of the bubble here represents the overall CapEx need. Now, we know that some of these are going to drift northwest over time towards that bankable zone. Again, these are regional averages. We also know that in some countries, some things are going to be in the money now, some things are not going to be in the money till much later. These are regional averages. The next question that we asked ourselves when we looked at these bubbles is, how much of this CapEx, how much of these projects are actually bankable now, and how much can be unlocked through blended finance? So what we have here, we took 3 examples. Wind power, you see on the left, $240 billion needed per year for the next decade. Of that, 125 is financeable today through private finance. And then we believe that blended finance can unlock the remaining 115. Now, the mix of that, those instruments are a little bit different. That's the point of this chart. If you go down to that bottom row, you see how it splits between investment grants, debt equity, guarantees, and so forth. Now, in this case, because wind is a well-known technology, we actually know the returns. However, there are local market challenges. There are local market challenges in getting to scale. For example, offshore wind in Vietnam, offshore wind in Philippines. That's why the skew of the instruments here are more focused on co-investing or guarantees and supporting mechanisms that actually establish markets. Whereas in the middle, that is retrofits. This is energy efficiency. Well-known technologies, often in the money already. So you see a much smaller need for capital, $120 billion per year. And you see that most of that is already, should be financeable today. And then on the right-hand side, that is CCUS and hydrogen for use for industrial decarbonization. That's not going to be in the money until, or at least at scale, before 2030. So you see much smaller need, $40 billion. And you see that at the bottom there, the mix of instruments is actually quite different. Here is the full range of instruments that are required. So that is what we've looked at for each of these different sectors. If we sum that up on the next page, please. You see that we believe there's a massive potential in using blended finance. We believe there's a $900 billion potential in the middle there. We need $300 billion per year in public and philanthropic capital, in catalytic capital. That could unlock $900 billion worth of investments. And that $900 billion, we're just putting it in the context of that $2.4 trillion that I showed right up front. This is just below 37.5% of that $2.4 trillion. So we believe that the potential in blended finance to be part of the solution here is tremendous. However, there are many barriers to this. And again, I think Ravi covered many of these in his opening, so I'm going to do this quickly. The first one is simply challenges coordinating across different public and private investors. The different investors have different risk-return targets, they have different pace, different time horizons, and so forth. It makes it challenging when you're trying to develop shared initiatives. We see limited innovative financial instruments that actually meet the needs of institutional investors, for example, for standardization, for diversity, for liquidity, and so forth. We also know that there is now lack of fiscal space for states. There is lack of financial firepower. We heard Dr. Reina talk about this from some of the developing institutions. And then finally, last but not least, is that there's a weak pipeline of bankable projects. So these are some of the challenges. We've looked at more than 100 cases of blended finance to date, and we've tried here to look at what can we learn from this, what models work. Now, I'm going to explain this as a little bit complicated chart. First, we need to distinguish between the different level of investing. That's the iceberg on the side. Some of this is at project level, some at fund level, some at institutional level. The second point here is that they spread across a spectrum. You see that spectrum going from left to right. So the emerging opportunities, these are the ones that are in that not bankable zone, all the way to near bankable. going back to the point around moving towards more bankable assets. A couple of things to note. First, you will see more activity on the left-hand side here, on these emerging or the more difficult contexts, newer technologies and so forth. So we've seen much more activity there. That's not surprising because historically that is what blended finance has been focused on. We also see on the left-hand side that we're seeing more activity in the higher levels of funding, so going down on that iceberg. We see more activity, for example, at the fund level, we see the tranched and debt equity fund, Climate Investor 1 in the middle. We see at the institutional level, IFC's MCPP, One Earth Initiative. So we're seeing more activity at the higher levels of funding on the left-hand side. We've also seen more activity on the right-hand side. This is a very good positive development. We're finding that we're seeing investing at fund and institution level. And this targets some of the more mature assets. These are often initiated by private institutions. We see BlackRock, we see Pentagreen Sustainable Infrastructure Funds, we see the ILX Sustainability Focus Emerging Market Credit Fund. So that is good news, because on the right-hand side, we believe that there is potential to tap into even more institutional investments or capital at scale. If we sum up the learnings here, we believe there are 5 imperatives to scaling blended finance. The first one is determining appropriate blending modality. At what level? Is it project? Is it fund institutional? How much is public versus private? So that's number one. The second one is designing a balanced and sustainable allocation of risk to where the projects meet that bankability threshold. But again, as Ravi said, also private institutions need to bear some of that risk, of course. Number 3 is to integrate blended finance as a key objective of global financial architecture. Number 4, introducing initiatives to ensure adequate public financing through national development banks and green banks. And then finally, not least, we need to implement ambitious real economy policies and corporate transition plans to deliver a strong pipeline of opportunities. Let me end by summarizing. Number 1, we have a $2.4 trillion need across APAC, a massive need. Number 2, we believe that blended finance can play a big role in this. We believe blended finance can catalyze up to 40% of that $2.4 trillion. The last and final point, in order to achieve that, 5 key imperatives. 5 key imperatives, both at the initiative level, as well as enabling system-wide change. Ladies and gentlemen, thank you very much for listening, and I am delighted to be here in front of you today. Thank you.